Our perception of money is changing rapidly, and banks are at the center of all of it. From how we access it, to how we buy, to how we trust that that money will be there when we need it. I'm Kiah Haslett, the creator of Fintech Takes Banking. Here on Bank Nerd Corner, I talk with bankers, economists, academics, and more about the complex dynamics shaping the financial services landscape. This week on Bank Nerd Corner Squared, Alex and I catch up after his whirlwind tour of the spring conference circuit. Alex shares his observations from visiting both ends of the conference universe, Fintech Meetup in Las Vegas and a fintech-focused event put on by the Bank of North Dakota. We then do a timed round of news stories and analysis, 10 minutes on different topics, including the White House's new report on yield-bearing stablecoins and Chime's new Prime membership tier. We then talk about some exciting and interesting news in our particular industry, which is tech newsletters becoming the hottest target for tech firms. Hey, Alex, thanks for joining me today.
I am delighted to be back. Thank you for having me.
Yeah, you look like you are in a familiar and stable location with a familiar setup. But you have been all over God's green earth. How has it been?
It has been lovely. I went to two places that I think are maybe polar opposites. They might be the exact opposite places. One is beautiful, sunny Las Vegas, Nevada, a place that I visit multiple times per year, every year like clockwork. I was there for Fintech Meetup, which I've been to many times before, but the first time ever it was held at the Mandalay Bay, which is a hotel that I've spent almost no time in.
Yeah, I don't think I've been to that hotel.
It's, it's a Las Vegas hotel. The hallways are like way bigger. So like anything that like the Venetian is big enough, but like imagine the Venetian, but like the Venetian was designed by like the child of a giant, and the Mandalay Bay was designed by like the adult giant in the family. It's just like bigger hallways, rooms further apart. And so it was kind of hard to tell, like, was this the biggest Fintech meetup ever? Was it maybe a little quieter this year? Like, it was hard to say because it was a weird space.
When you change the space, it's like, it's like a big box and a small box, and it's like the optical illusion,
Yeah, exactly. It felt like being in it, it kind of felt like what I would imagine like a goldfish feels when it gets moved out of its tank because its tank is being cleaned and it's put in like a bigger tank. And it's like, this is nicer in some ways, but it doesn't feel like home. And so it was a very strange experience. And then this week, so very recently, I was in Fargo, North Dakota, which is not Las Vegas in pretty much every way, I would say. It was cold. It had snowed.
Wow. April.
Like I was sad I didn't have like a winter hat was how cold it was. And I was there for the Bank of North Dakota's fintech event that they have started to do. This one was very stablecoin focused because Bank of North Dakota is going to be launching its own stablecoin. But the room was filled with community bankers, and like, quite frankly, Kiah, I learned more about like agriculture banking and agriculture lending than I had ever even known to ask. And it was pretty interesting listening to bankers who probably know more about farming and ranching than some farmers and ranchers do, but they're bankers, and so like they were just like they could tell you everything that was going on with like the price of diesel and the availability of fertiller. Like it was a lot. And
tariffs probably like
tariffs were
that
huge,
matters in ag.
Huge thing right now. And so that was fun. I met someone who is working at the bank with his dad. So like kind of the family banking thing still alive and well in North Dakota. I was asking him like, how big is your loan book? And they were like, yeah, it's about $70 million total. And I was like, oh, how many lending officers do you have? It's like, just me and my dad, and it was like, it was such an interesting window into like, this is banking too, but like those, did you
ask him about online banking or,
Oh, yeah, we talked about it. And like, well, I mean, and like the whole event was like stable coins and like crypto and stuff. And so it was so funny watching someone who like is one half of a father-son loan officer team at this teeny tiny bank that serves this community sort of trying to wrap their heads around stablecoins, tokenized deposits. I mean, you
Yeah.
remember our legendary discussion about tokenized deposits and like, what is this? Like,
Yeah.
imagine that sort of like brain melting, but happening in the whole room with
Right.
community bankers. It was a really fun experience.
And for our listeners who don't know, the Bank of North Dakota is the only state-owned bank in the country.
Yes,
And which means that it's like legit owned by the state government, which
it
and
is.
like I think their board has some political appointees on it, like the
Hmm.
governor, and
Hmm.
it's just a very different role, and obviously it's completely foreign and unfamiliar every time I would talk to someone from the Bank of North Dakota and they would say something, I would just be like, that's so close to a normal bank. You're so close.
Mm,
And you've just kind of turned it on your head. But it's, and I feel like we just don't see that in a lot of parts of the country or many parts of the world, in part because um, state owned institutions can be like pretty easy targets for corruption. So I'm really
sure.
happy that they've made it work in North Dakota and they serve as a correspondent bank for the North Dakotan banks, right?
They do, yeah. I mean, the analogy. This is kind of an overly simplified analogy, maybe, but the analogy that occurs to me is in the same way that like credit union servicing organizations sort of exist to like help all the credit unions that like work with them kind of up level their game and cooperatively invest in technology and stuff. Bank of North Dakota plays a similar role,
Right.
but it is interesting because it's owned by the state. They like actually are like the sort of financial services arm of the state too. So when there's like disbursements that have to go to citizens or there's things like that, like they're the bank account for the North Dakota state government, and so
Right.
like it's fascinating. It's kind of this like three-party arrangement between Bank of North Dakota, all of the banks in North Dakota, and
Hmm.
then the North Dakota state government, and they all kind of work collaboratively together. And it was very nice. I mean, Kia, you
Yeah.
and I sometimes joke about like, am I sort of a socialist
I
in
was what I was
secret?
hoping you'd bring up socialism
Yeah,
actually.
yeah.
Yeah.
And honestly, this so I was sort of like socialism, like more cooperation, more state-owned enterprises. Like I was like, this kind of works. So at least in beautiful, bountiful breadbasket North Dakota,
Yeah.
just filled with all these rural communities. We talked a little bit about with some of the bank CEOs, like data centers is becoming a topic because North Dakota is wrestling
Sure.
with building of AI data centers and should we allow this in our communities and what will be the impact? And we were talking about the fact that North Dakota is kind of ideally positioned in a lot of ways because they have
Yeah.
ample power generation. They're well sort of built from an infrastructure perspective. It's cold, so the data centers won't get too hot. Like there's just a lot of things to like about building data centers, but at the same
Sparse
time, they're
population, an entire
yeah,
part of the country called or a state called Badlands. Yeah.
right, right, right. So like, there may be more data centers coming, but at the same time, people are sort of scared of AI taking their jobs and just object to
Sure.
data centers on those grounds. So a lot of stuff
The
happening,
gr-
even in North Dakota.
if I had to stereotype the group of people that I think are least interested in using agentic and generative AI, it might be North Dakotans. You know what I mean?
I was talking to him about that actually because they were asking me like trends and things that I thought were interesting, and I was talking about AI, and it was fascinating because I definitely got the sense that most of them in the room. I think I asked a question actually where they raised their hand. I'm like, who's at least experimenting with it? And to their credit, they mostly all raised their hands, but I didn't get the sense it had quite gotten to the same production ready. This isn't just a little thing I'm playing with on the side sort of
Yeah.
stage. So still early, and definitely old school in a lot of ways. A lot of ways, quite frankly, that I appreciated.
Yeah.
Like I'm from Montana, so like these are kind of my people. And like we were talking about like well, is this thing that's happening in fintech? Like, what about the privacy implications of that? And like, you only ever get asked about privacy when you're in the Dakotas, Montana, Wyoming, Idaho. Like, the rest of the country doesn't care. But like, if you're in the sort of mountain Midwest area, privacy is a thing we care about. So
Yeah.
it was fun. I was with my people.
Um, the other thing, and I promise I won't talk about Didmika for the rest of this episode, but when I was reading about the historical reasons why different states had opted out of Didmika, several of them opted out of Didmika on the principle that like the government doesn't get to tell us what to do. And so we have to opt out because we need to be in charge of our state's interest rate and our state banks or whatever. And like that even sentiment feels like a Mountain West, like an Upper Midwest sentiment, right? Like, so
yeah.
The privacy thing too, you know.
Totally. Like you can't tell us what to do, you know. There's very much of that sort of don't tread on me energy up here. So no, it felt familiar, but it was also interesting because like everyone else, they're wrestling with stablecoins and AI and all the rest of it, and they're looking the problem right in the face. And I think what Bank of North Dakota is doing from a stablecoin perspective is actually pretty interesting. And one of the few, like when they explained it to me, I'm like, oh, right, that actually makes a lot of sense. And you're using it as payments infrastructure. That's great. Yeah, I get that. So no, it was time well spent. I'm glad I got an invitation to go.
So you have been traveling all April and all March, basically.
I have.
Out of all of your travels, what was your favorite moment?
Oh gosh. You know, so it's a tie with two different events I was at over the last 3 months where I got a chance to talk to college students.
Oh, how fun.
Yeah, it was really fun because a couple of the events I was at, including this North Dakota one, were done in partnership with the local university. So in this case, it was mostly North Dakota State University students who I have a fierce football rivalry with. And I actually wore my alma mater shirt one of the days and, you know, definitely got some booze. So that was fun. But it was really cool to talk to them and to talk to students at an earlier event from the University of Utah.
Right.
Because, like, you know, I mean, we spend so much time talking about, like, here's what Gen Z is doing. Here's what Gen Z wants. Like, here's the future of fintech, blah, blah, blah. But you don't actually spend that much time talking to college kids.
No, talking to Gen Z and college students it's rough.
Yeah. Well, and the thing that's funny about it is I think it's one of those things where your experience of it on the internet versus in person is very different, has been my experience. And in particular, the kids who are in these like finance, banking type programs where they're expressing an interest in fintech, the folks at the fintech club at the University of Utah, they're very impressive. And we did a whole set of things where we were talking about what's going on in fintech, and they had really great like questions. And there was a question that somebody asked at the North Dakota event. One of the students asked like something like, what would the banks in the room do to entice the students who were there to want to work for the banks? Like, what's the pitch?
That's a real problem.
It was a great question, and the bankers were kind of like wrestling with it in real time. So, no, I really enjoyed the opportunity to get to talk to college kids. That's been really fun.
From your travels, what is the theme that keeps popping up or that you keep thinking about?
So I can't get away from AI as the topic. It was I can't stress to you enough. It was everywhere at Fintech Meetup, and I'll put a specific point on it that has surprised me and has occurred to me. I was under the impression that AI would follow the same trajectory within financial services that every other technology follows, which is big banks adopt it first. They have the resources and the ability to move fast. They're not dependent on their core providers to wait for innovation, blah, blah, blah. And then it trickles out slowly to the rest of the market, and eventually it filters its way down to community banks. AI seems to, in some senses, be the opposite. And what I mean by that is if you're like a Chase or a Bank of America or a Citi, in a lot of ways, AI is kind of like more risk than it is reward, because like you have a ton of data. So if your data gets leaked out or used in a bad way, you have a problem. You have a ton of employees who you could probably replace, but you can't do the thing Block did and fire 40% of your workforce without Elizabeth Warren dragging you up to Capitol Hill and making you answer for it and taking a lot of bad press. Yeah, that's how margin call starts,
you know? Like we can't do this.
Exactly. Loved your podcast, by the way. And so, like you can't really reap the full efficiency gains from AI because you have a PR problem then.
Right.
So, like big banks, they're obviously using AI and they're experimenting with it and doing, but they have to move slowly and cautiously. And they know that regulators are watching them and all this stuff. And by contrast, community banks, and I've now talked to a bunch over the last couple of weeks, both ones that are very interested in fintech and crypto stuff, and then ones who are like not so much. And all of them look at AI and they're like, oh my God, like this is a way that we can, like, for example, we could hire a UX specialist to work on our digital banking that's silicon, that's just like a chatbot, but we could like import that expertise just paying in tokens at a level that we could never hire ourselves, right? Like if
Yeah.
you're a community bank in North Dakota, you're not going to get someone who's an expert in UX design. Like you might
Right.
find someone who knows what UX stands for, but that's about as good as you're going to do with your recruiting and your resources. You can't like compete with Robinhood or with JP
Yeah.
Morgan Chase or PayPal. But with AI, you can. You can just like open up Claude and you can ask it for advice on how to redesign your website or whatever. So they view it, I think, as we now don't have the same resource limitations that we had before in terms of
Right.
hiring expertise. And we're not going to fire Mary and John who work in like as loan officers here because we're a community bank and we don't do that. But there's really no efficiency to be gained by doing that anyway. And so instead, let's give Mary and John junior loan officers so they can process twice as many loans. And so a
Sure.
lot of the banks I talked to were like, look, we have way more demand that we could go cultivate and go after. But like I was talking to one person who was saying like, we do loan participations not so much from a risk perspective, but because we have to get this stuff off our books because we're like capital constrained.
Yeah.
But we want to loan more. And so the idea that like efficiency and like expertise can be available to community banks. And by the way, you're not getting this through your core provider, right? Like it doesn't
Right.
need to come through your core.
Yeah.
I think it's much more impactful for community banks right away than I've ever seen with any new technology that goes through financial services.
Yeah, and I think that's so interesting. I was talking to Madeline Friden about
Yeah.
how for a lot of AI technologies, the banks aren't too late, or for a lot of use cases,
Yeah.
they actually haven't fully kind of lost this race for adoption. And the kind of the question is whether the banks themselves, one, can find a use case that they're really comfortable with, and then two, can really identify like not just what paper-based process can we digitize and then add AI to it, but like genuinely what would we do if we had unlimited amounts of people and could pay them to work here, and then what then? So like that UX example, right? Like maybe they just haven't been able to prioritize it, so it's not something they've ever been able to say like this is important to us. And now they do get to say it is important to us, and we can actually try to do this thing that we've always wanted to do, but we had to either prioritize or give up doing it because we couldn't find talent.
I think that's exactly right. I mean, it just sort of like it opens the aperture up of what you can choose to emphasize and compete on. And the topic of conversation, especially at the Bank of North Dakota event, was okay, what do you do then? Right? Like if this allows us to sort of do anything,
The world's your
which is
oyster
cool,
now.
the world's your oyster. What do you want to do? And I encouraged them, as did other people in the room, to just really sharpen your focus on the customers that you know who you want to win with, right? Like don't try to be everything to everyone. Don't try to play the same game that other bigger institutions are maybe playing. Like, how does this allow you to serve farmers in North Dakota better,
Right.
And that seemed to really resonate. And I'm sensing a level of like cautious optimism around AI from community banks
Yeah.
that I just did not anticipate relative to other previous technology waves.
Okay, so my final question from your conference download
Yeah.
dump is
Yep.
what what tips, travel tips, attendance tips, packing tips
Yeah.
did you pick up or adopt or use in your nonstop travels?
These are great questions. Well, let's see. So I will say off the top that not that I've been going through like every single busy airport in the world, but the whole like disruption to TSA
Oh yeah,
is
you
way
got-
overblown, is
Oh,
my
was it?
experience.
Okay,
Yeah,
okay.
in my experience.
Well, that's very lucky for you.
Yeah, and maybe I'm just lucky, but I think it points out something maybe that's important, which is The internet really gives us a distorted view of the world where it's
Oh, you don't say.
this one little thing goes viral and suddenly like in my head I'm thinking, "Oh god, every airport in the US is completely overrun and it's going to be 3 hours of a wait everywhere."
Right.
And in reality, those are more like sort of singular instances that then sort of it's the availability bias, right? Like the thing you see online is what you assume everything is.
Yeah.
And that has not been my experience. So travel's been going okay.
Okay.
Conference attendance tips, I would say that people probably spend too much time in like the defined spaces at conferences and not enough just walking around. And this is not necessarily a pitch to spend more time in the exhibit hall. I'm not saying that necessarily, but like I tend to find that a lot of folks just like to kind of wander the halls and just kind of chat with people because everyone's in
Okay.
the same place. And so while it's important to go to sessions and it's important to like for Fintech Meetup, participate in the meetings program and try to meet with people, like don't underestimate the value of just wandering around and kind of bumping into people and oh, what do you do? And like some of the best conversations I have are unstructured. So
Sure.
leave time for unstructured time, I guess would be my piece of advice.
All right. Well, thank you for doing this correspondent
Oh, you're
for
welcome.
us
Yeah,
and
yeah,
going
yeah.
to all the events so
Fintech
I didn't have
takes
to. Yeah.
event correspondent. Yeah, I'm happy to. We're gonna see each other in person pretty soon.
Right, in New York.
Yes, for New York FinTech Week, we have. Speaking of AI, we've got AI oriented
Yes.
conversations coming up. So I'm excited. Basketball too
I'll
for
get
anyone
some
listening.
event contracts on the 3v3 tournament going.
Everyone should short me as much as possible. Like whatever team I'm on, just try to take the under on that. And now, Kiah, I think you have like a different format for us
Yeah.
today.
So we have observed that many of the news items that come out every month were kind of something we talked about in the past because we're really good at our jobs.
Yes.
Um, and I didn't want to make these into full segments, so I
Hmm.
thought we would do lightning rounds. I
Okay.
thought that when we did our white collar crime fraud 30 under 30, the
Hmm.
timing component was fun and not stressful. And so
Speak for yourself, madam.
today, I took all of the topics that we put in the outline and I assigned them to each of us. And I am giving us, you and me, famous yappers,
Yes.
a 10-minute 10 minutes to talk about it.
Okay.
So the first topic is yours. And I will start my timer once you go, and I will provide a 5-second countdown.
Okay. Ready?
Yep.
Okay. This is White House releases report on the impact of yield bearing stablecoins. So, the White House Council of Economic Advisors just published a report on the impact that stablecoins offering yield will have on the banking market. As we've talked about in the past, this is like the topic that has been hanging up the Clarity Act, which is the market structure legislation for crypto. It was a major point of contention with the Genius Act and now with the implementing regulations for the Genius Act, which are starting to roll out. And the basic contention is from the bank's perspective, they argue that yield bearing stablecoins, so basically offering a place for people to store their money and get yield on
Yep.
that money. So, like a savings account, not a checking account, the ability for stablecoins to act as a savings account will cause deposits to flee the banking industry.
Right.
The number that you hear bandied about is $6.6 trillion, up to $6.6 trillion in deposits, which is spoiler alert, a lot of deposits. Also, spoiler alert, that number was always nonsense. And I wrote about this in my newsletter, but like it was just a number that literally they grabbed out of a random treasury presentation and just started presenting it with no context whatsoever. So we always
Right.
knew 6.6 trillion was like way too aggressively high from the bank's perspective. The White House in its newest report, and let's not totally pretend that the White House is like a completely neutral observer on this topic, but the White House's report said that the number is closer to $2 billion, which Kiah, just quick math class, 2 billion is significantly less than
Then
6.6
yeah.
trillion. like orders of magnitude less. And 2 billion represents like 0.02% of the overall deposit base in banking. So a rounding error functionally.
It's like one community bank.
Yeah, pretty much, pretty much. It's one community bank's deposits. And, that is, I think, a good indication of the range of possible outcomes. Now, bank advocates have already jumped in and argued the other side, which is like, no, 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 you're not understanding. It's actually probably a higher number than that. And they miscounted it in these ways. No one really knows. But the thing I thought was most interesting from it was that the bank's argument quickly shifted from the raw number of deposits that
Mm-hmm.
would flee to instead talking about the displacement within the banking market.
Yeah, the
And
distribution.
so their argument is the deposits will shift from community banks to big banks, because if people are keeping more money in stablecoin reserves, a lot of that will functionally still end up being held by banks, but it'll be held by large custodial banks like a BYN or a JP Morgan Chase, organizations like that. That's the concern.
So I have a couple of thoughts.
Yep.
Number one, and we're at 3 minutes. So number one,
Okay, we're doing good.
Why, like, stablecoin did not start existing in 2024. Why don't we have better data about this? Why weren't we keeping track of this? Part of me is like, it's because it just wasn't being asked about in the call report. This piece of information, we don't even know, like, how many BAS deposits there are at banks, because we don't break it out, and we don't ask how many of these deposits are coming through stablecoin. And so the New York Fed did a study about what happened when SVB failed, and then all the stablecoin deposits that either were at SVB or moved in response to SVB, and they tried to like track. And the Fed has ways to like delve into these numbers that are not publicly available, and they declined to list the banks in the study. But they found that in at least post SVB 2023, it was like a handful of banks under 100 billion in assets got most of the deposits, and then they were able to the stablecoin deposits, and then they were able to see what they called it a deposit shock, because it was just so many deposits. And at all of the institutions that received the deposit shock of stablecoin specifically, they became narrower banks. They had to maintain larger reserve balances, and they decreased lending relative to peer banks. Now, that doesn't say anything about, it doesn't say like, did they make more money? Like,
Sure.
But to the degree that those are two outcomes that should be watched, that was interesting. But what I don't understand, and what I've tried to understand, is like, if banks are so worried about some of their deposits moving out and becoming stablecoin reserves, or moving into stablecoin accounts, I'm like, okay, so has that like happened yet? Like, has that? How much have you looked at your deposit flows into Coinbase? Are you seeing do they ever re-enter your banking your bank? And like, have you started modeling for that potential stressor? And like, as far as I can tell, the answers outside of this New York Fed study is no.
Yeah, I think that's true, right? And I think that obviously, like Silicon Valley Bank was overexposed in terms of its customers and the work that it did. So it was very heavily exposed to stable coins relative to sort of a normal bank. But I don't know. I mean, I think that it's a great question, because like Coinbase has been offering rewards on USDC for a while.
I know. This isn't new.
PayPal has been offering rewards on PYUSD for a while. I don't really get why all of a sudden we're seeming to think that, like, if this happens, like if it's made legal under the Genius Act and they can offer yield, like let's just say, like what's the worst case thing that's going to happen? Because like the questions I've been thinking about are things like, well, doesn't aren't there still lots of above market options, right? Like you don't offer a competitive interest rate on your savings account.
Yeah.
there are plenty of other places that a customer can go if they're trying to optimize for yield. They can go to neobanks, they can go to money market mutual funds, they can go to just all kinds of
High
different
yield
places,
savings,
high yield
yeah.
savings offerings. Like there's little community banks and credit unions that are always winning on the list of like highest CD or whatever. Like there's lots of places
Right.
you can take your money. And I think banks don't give themselves enough credit for the stickiness they have with their core deposit relationships. Like just because stablecoins can offer yield doesn't mean that that yield is going to win. A. B, the other thing I find kind of strange about this is like, why do we think that Coinbase, if they're allowed to offer yield, will continue to offer like the best possible yield available? Like, how's
Yeah, you think like
Coinbase going to pay for it?
wouldn't they want to become like the JP Morgan of crypto
course.
exchanges and then
Of course.
offer as like cheap or like try to underprice their
Totally.
rewards?
Well, and you've already seen this, right? Since Coinbase has been making such a big deal about this, they've actually dropped the rate they pay
Amazing.
on USDC multiple times, despite the fact that they have an incredibly lucrative distribution partnership with Circle to distribute USDC. And it's like, if Coinbase is doing that, even though interest rates are still relatively high and blah, 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 yield on treasuries is still relatively good, like how do stablecoin and stablecoin adjacent companies make money? Is it more profitable and more durable across multiple economic cycles than lending? No. So won't banks be in a better position to compete to the extent that they have to on yield than stablecoin issuers and crypto companies? I think yes. And so I can't get a straight answer from people on like, why is it that if this happened, we think all deposits would flee out of it? So I'll be honest, I'm more sort of just naturally predisposed to believe this new White House number. It's probably closer to the 2 billion end of the spectrum.
Right.
And to the extent that money is going to move from community banks to large banks, isn't that just part and parcel of the ongoing saga of how much it sucks to be a community bank? Okay, so stablecoins aren't going to make, if stablecoins aren't going to make community banks' lives easier, what else is new? Like nothing that we've been talking about, maybe except AI, as I was saying before, nothing's going to make community banks' lives easier, but that's not necessarily a reason to stop it or to not do it. And so, I don't know, I find the whole argument strange.
In my last 20 seconds, I think we should also ask ourselves, what are the implications of stablecoins not receiving deposit insurance?
Yeah.
I think that's a fun question of, hey, well, maybe you can get some yield, but no insurance.
Yes.
We're out
And
of time
are they
on this
really
topic.
accurately reserved? Yeah. Okay. That was great. Lightning round. That was
All
fun.
right. Topic 2.
Do you need me to keep the time since you're not going to be
do
the one
it, but
talking?
if you'd like to also be annoying and be the referee.
I
here.
trust you. I trust you.
I'll start it. Ready?
All right. Yes.
So the second topic are the redux of rules that we've seen from the federal banking agencies. And I don't want to say they're capital rules per se. One of them is. I don't think one of them is. One of them is. One of them isn't. But it's basically that federal banking agencies are making it easier for banks to do mortgages and leverage lending. Through either capital treatment or kind of risk weighting or reserving or supervision scrutiny, without getting into specifics because no one wants to actually talk about specific capital rules. But the proposed changes on mortgages would change the deduction for mortgage servicing rights and lower the risk weighting on loans that had higher down payments. And then at the end of 2025, leverage lending guidance was rescinded. So this is another like guidance is guidance thing. And then it was just fully rescinded at the end of 2025. And I would now characterize the vibe of just be safe about it, which is, I think, the vibe of from many federal banking agencies when it comes to lending, right? Like just let the banks do their thing. They're the experts. They know their customers. I'm kind of of two minds about this. Number one, like one of the reasons that's cited in both of these changes is that this financial activity went outside of the regulated perimeter. It just was it wasn't like you weren't getting returns on this kind of activity. Other non-banks were able to do it because they didn't have capital rules or they didn't have the same supervision, were able to do it. And it just went outside of the banking agency. Now, I know why we went so hard on mortgages. I know that banks did stupid stuff with mortgages. And
explain it to me like I'm a golden retriever or a small child.
See, and yeah, I don't want to say they deserve to get in trouble. That's not like what this is. But basically, they were just proven that they can't really be trusted to do it the way that we had been doing it. Like, it got so stupid out here that the regulators were like, well, I guess we have to be more present. And if you can't reserve or make a loan that's not fraudulent, that has documentation, that's not a PVC farm, then we'll just make it really hard for you to do these loans. And so if you want to do them, you'll really have to want to do them. Or don't do them. And if you don't want to do it, don't do it. No one can force a bank to make a mortgage. Mortgages are pretty commoditized products. And other companies can just do it. I feel like that's what happened with mortgage. Leverage lending is a little different because they leverage lending, at least post-financial crisis, it never cracked, but it was just an area of risk-taking that regulators didn't love. And a lot of banks were doing participations, like shared national credits. And so leverage loans often go to companies that have lower corporate ratings. So these are
well, this is what we talked about with private credit on the previous episode, right?
Well, we talked about private credit. That's post leverage lending guidance, right?
Right. Private credit booms because leveraged lending guidance is banks stay away from this kind of a thing. Yeah.
Yes. And so for me, as a bank reporter, I'm like, wait, I think these are fine outcomes for the banking industry.
Yeah.
So I think it was one of those things where it's kind of paternalistic, but worked out for the best. Sorry, the parents were right. But then, I kind of I don't know if having rescinded the guidance or changed the rules, the banks want to be in this business. So I'm kind of two minds about these changes and why does it matter? Why should we make the change? And then why should should I care about it or not?
So really good points. I agree with you about being of two minds about it. So on the one hand, so this is a reaction to the great financial crisis.
As many things are in this industry.
As almost everything that we live with now is in some sense. And regulators were shaped by that crisis, and this is how they think about it. I do think being harsh on mortgage specifically is a little bit silly and not necessary, perhaps. And the reason I say that is that if you go back and watch Margin Call or you watch The Big Short or whatever, one thing that's very present in the commentary is this idea that everyone screwed up their risk underwriting and their risk management based on this fundamental assumption that, well, who doesn't pay back their mortgage? Mortgages had never gone down or failed ever in the history of mankind. And there was just this idea that they couldn't go bad. And I think that since the great financial crisis, everyone knows they can. And so one part of me thinks it's not necessary to be overly aggressive in scaring banks away from mortgage because everyone, including the banks, remembers the great financial crisis and they won't make that stupid assumption again that mortgages just can't fail and have some special magical property that stops them from failing. So that would be one side of the argument. The other side of the argument, though, is I'm not sure why Mickey Bowman thinks it's bad that banks are not doing mortgages. What?
I know.
What's the problem? You know what I mean? What are we trying to solve for here?
It's not banks don't have a God-given right to do mortgages, right?
Is she saying that banks can do mortgages better? Is she saying that we would have less of a home ownership and home affordability crisis if banks were doing mortgage lending? I don't understand what the counterfactual is here. What would we have? Let's say that these rules were never in place and we never sort of scared banks out of mortgage lending. What would we have now that we don't have today? And I don't know what the answer to that is. I'm not saying there would necessarily be more risk, but like, I don't know. I spend a decent amount of my time talking to regulators or ex-regulators, and like they love it when risk gets pushed outside the banking
Yeah,
system.
I thought
Like
that was good.
they're all for it. They're like, our job is to stop bad things inside this little perimeter from happening. So if we can push dangerous things outside, like they're okay if private credit blows up. They're okay if whatever happens. Now, that might be bad from a consumer protection perspective. That might be bad still from a macroeconomic perspective. So maybe the argument is something like it's better for risk to be taken inside the banking system because it can be better supervised, and the
That's
shadow banking thing is more
That's what
dangerous?
they say. They make that argument, but like, it's funny you're talking about this for mortgage because I just talked to Dan Avery and Jason
Yeah,
Mikula about banking as a service, and
yeah.
they're like, "Hey, I would love some intellectual consistency around like risk being in the industry or out of the industry because I don't know if I think consumers." Were harmed by mortgage moving outside of the banking industry. But I can tell you, like, the inversion of banking as a service
Yeah.
somehow left many consumers outside of the banking industry or the protections of the banking industry or the supervisory purview of regulators.
No, totally. Well, and the other thing I'll say about mortgage in particular is mortgage is by design a very fragmented market, a very specialized market. Like when we created Fannie and Freddie, the idea was we are not going to make this a balance sheet business for banks. We're going to make it an origination business. We're going to make it a servicing business. But the idea was everyone can kind of specialize in their own little pieces. So to me, where we are right now with the mortgage industry, like it or hate it, it's kind of the natural endpoint
Yeah.
of a highly specialized system where everyone plays their own little role and where banks' role is kind of minimized. And it's just weird. Like, it's weird to have the Fed come out and say, banks should be more competitive in mortgage. It's almost as if you're listening to like a venture capital investor complain about how their startup is getting locked out of a market. Like, who cares? You know
Yeah.
what I mean? Like,
Yeah.
why, like, banks are slightly less profitable because they can't play in this one little area because we don't think it's safe. Like, who cares?
Well, the other thing I remember is that like and mortgage servicing income money is money, but that mortgage
Sure.
servicing income was received by investors as volatile
Yeah.
and therefore discounted. They were not seen as quality earnings.
Yeah.
And so and like I don't know if a bank loves like hiring and laying off like hundreds of people
Sure.
during booms and busts. And
Yeah. Mortgage
like
is a highly cyclical business.
yeah, so it's just one of those things where I don't know if like many banks are like, yeah, money is money, let's do it, or if banks are like this isn't durable income, it's very disruptive, it's very market driven, and so let's just leave it.
Yeah. Yeah. Like, are people having a hard time affording a house? I will say, as a last note, I think mortgage servicing is a really underappreciated opportunity. And I wouldn't mind if mortgage servicing became something that banks were more interested in, but I don't know that we should be contorting the whole
Yeah.
regulatory system to require it.
All right, we went over 7 seconds. We'll do better next time. Alex, topic 3.
Okay, topic 3. This is Chime adding a Prime membership program to move up market. So it's called Chime Prime.
I don't like
Chime, of
that. I don't like
course.
that it rhymes.
You either, I mean, you're not a dad. I liked it. So
Right.
like dad humor, like I was all for it. I thought it was great. So the way that this new premium membership tier works, it's not a subscription because you don't have to pay
Yeah.
a fee for it. You have to just have a certain amount of money in your Chime account. So the basic way it works is Chime members, and they use the word member because they're kind of a credit union in some ways, although legally not a credit union, but that's how they think of themselves.
Not a bank, not a credit union, a
Not a bank,
secret
not a
third
credit
thing.
union, a third thing, but they use the word members. They're members who receive at least $3,000 a month in qualifying direct deposits will automatically unlock Chime Prime. And if they do so, they gain access to a bunch of benefits, including 5% cash back on a spending category of their choice. So groceries, gas, restaurants, monthly bills, rideshare, or travel while using the Chime card. up to $1,500 in eligible purchases per month. They will get 3.75% APY on savings. It's funny, I don't see banks like flipping their lid about Chime offering 3.75% on interest. It's weird. Isn't that going to lead to deposit flight or deposit displacement? Anyway, um, premium travel and lifestyle perks, including Kiah, priority pass membership, luxury
I'm
hotel
so
benefits.
mad about that.
I
I'm
know.
so mad about this.
I can't wait for you to complain about that. And concierge services with Chime Card. They'll receive fee-free overdraft with Chime's Spot Me product, access to $500 before payday with their MyPay program. So those are kind of their existing overdraft alternative and short-term lending products. Instant loans. They will get priority 24/7 support, which is a thing I'm seeing more in neobank world, is like, hey, our customer support's not very good, but if you are qualified for our premium thing, we'll get back to you faster. So I don't know how well that compares against traditional banks, but maybe against other fintech companies. You will get an Chime card in Onyx, a premium metal card design. Ooh, very fun. And then you will get access to exclusive experiences, including VIP giveaways, blah, 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 blah. So I don't know. I find this to be interesting. I do think that, and I've written about this, I think there's this notion that credit cards are increasingly becoming this like very expensive, very complex game for a subset of the population to play, and a lot of the market is being left behind. You're one of those people, so I don't necessarily expect you to understand what I'm saying here, but
I've heard of this idea.
You've heard of this idea, yeah. So I think there's something to that, and the idea of building like broader based membership programs that more people can participate in. So I think that's great. I do think that at some point the Chimes of the world might need to explore like a paid subscription product. Like, I don't know that just getting enough qualifying direct deposits, and then presumably the idea is like more debit interchange because you're using them more as your primary bank. I presume that's kind of the argument for how they're going to generate more revenue through this. I haven't seen their internal math and like how they're calculating that, but it seems like quite a bet on capturing primary account status and then the subsequent interchange revenue that will be generated from that. And I'm not 100% sure that math is going to pencil out, although I can understand the theory of it. So I think that's kind of interesting. And then, more broadly, I just am very curious to understand how consumers perceive this, because credit cards, again, they're their own special category. They're marketed in a very specific way. And so a lot of people will have like, here's my bank, and I do all my banking things with my bank, including like getting loans. Maybe it's where I have my mortgage. Like, this is all my bank. And then I have my credit card, which is a totally different thing, or my set of credit cards. And like, credit cards and banking as primary relationships, it's almost two different categories of primary relationships.
Like the product, like they're being, as products are being divorced. Right.
Exactly. Yeah. So like for a long time, I think people have thought of credit cards. I have my primary credit card, my top of wallet card, and then I have my banking relationship and I have my primary bank. And those two things often are not the same institution. And this sort of feels like trying to blend those two ideas and say, can we attract people who are looking for top of wallet-esque benefits, but have them get those benefits by choosing us as their primary bank?
Well,
and I'm curious
Alex,
to see how that math works in their head.
The glorious return of rewards checking?
It is absolutely the glorious return of rewards checking, which is a thing that went away when we capped debit interchange. Now, obviously, Chime works with banks under 10 billion, so they're getting Durbin exempt interchange. But even still, like, rewards checking was not the most lucrative business on its own. And like, I think most banks offered it because they wanted great deposits that were stable that they could then lend off of, which Chime does a little bit of, but not a ton. And so I have some business model questions, but I also have some kind of consumer psychology questions.
Have I misunderstood? Like, so, they always say in the credit card space that that debit card purchases subsidize the credit card users. And so I just want to thank everyone in advance who is going to do Chime Prime for swiping their interchange and then continuing to subsidize my rewards. Because it sounds like, there is a real subsidy here for especially that 5% spending category a month. I have a credit card that has one of those but it's for a quarter. So it's $1,500 a quarter. And so the idea that you would get like groceries, $1,500 in groceries a month and get that $500, is it 500? Whatever it works out to. I can't do math that fast, but that's nice. Like that's a very special benefit. And I was under the impression that, debit card interchange did not generate that. The other thing too is like, I can't tell if like Chime is going after trying to get, your card to be the card for all of your purchases, or the card that you would use in this category, the way that like I'm a broken person and have like each card that I'll use for every type of purchase. I don't know if they're training their customers to like do this. And then the other thing too is the $3,000 monthly direct qualify. Like are they trying to go like up market in who uses them based on that direct deposit?
They definitely are. And they've talked about explicitly the fact that they want to go up market. They want to, I think they're kind of redefining their target market from people who make less than $100,000 a year to people who make less than $200,000 a year, or to put it in more broad terms, like everyday Americans. And so they're trying to sort of widen the aperture. I think this is designed to go up market. I'm really curious to understand, like, I'm trying to think of the right way to put this. What's the delta between the old Chime customer who would never, ever get a Chase Sapphire card, who makes much less than $100,000 a year, and just wants banking that's less annoying and overdrafty and whatever? People who really like live paycheck to paycheck more based on income than on expenses, if that makes sense. And then there's that. Then there's the like Chase Sapphire, Amex Platinum sort of end of the market. And then I guess the theory is there's a middle market between those two things, which is consumers making up to $200,000 a year, who have a little more disposable income, who can put $3,000 a month or more into direct deposit. And by the way, $3,000 a month in direct deposit, that's still a fairly low income annually, right? Like
it's not so hard, but it is like I can definitely see
it's
that
slightly higher than they've been aiming in the past. I think in some ways it's more about consolidating primacy than it is about. So like a thing that you see a lot, and actually I was just looking at some data from JD Power the other day about this. A lot of checking accounts that are open these days, most checking accounts that are open these days, are opened as a secondary account. So you already have a checking account and you're opening a secondary account.
You're not getting baby's first checking account over here.
No. And so I think Chime benefits from it being the account people try, right? Like, so they have a lot of like secondary accounts. And I think one thing they want to do with this is we want to convert you from using us as a secondary account or a thing that you kind of mess around with, or maybe you use it to just get access to like fee-free overdraft stuff or like the short-term lending. We want you to go from that to using us in a more primary way, which is getting that at least $3,000. I'm sure they picked $3,000 very strategically to try to convert some of those secondary users.
In our last 15 seconds, I will say that SoFi just announced a paid membership tier and with a higher savings rate. And my friend just texted me, was like, do I still get my like higher savings account rate without doing this? And I was like, yes, you do. That one includes unlimited visits with a wealth advisor, which I thought was interesting.
That's interesting. Let me say one more thing about this. We are also seeing the blending of debit cards and credit cards in this space. And so when you were saying debit interchange versus credit interchange, I'm not 100% sure that's true because Chime offers a secured credit card. And it might be that card that's actually generating interchange.
Oh, maybe. But like on this one, it said Chime card. And when I clicked on it, I think it's their debit card.
Okay. So
I think like, this is tied to their debit card product.
So I guess the point is, how do they bundle their different cards and the interchange rates those cards come with into these different membership programs? That's a little maybe TBD as we'll see how it rolls out.
All right. Well, we did terrible on the timing on that one.
I like how strict you're being about this. Like we failed utterly because we took an extra 20 seconds.
One of us clearly did Toastmasters and did 7 of her 10 speeches, and one of us. And then, at Bank Director, the events are famously on time, and that's not an accident. So,
I will. So, just behind the scenes, I will tell people that when we did the FinTech Takes Builders Summit in Montana, I gave Kiah a really great session, and I was not a hard ass about timing. I was like, "Yeah, go up there, have fun, whatever." And she was like running Mike Sue, who she was interviewing, like off the stage, and like being like, "That's our time. It's over." Pushing him off the stage. I'm like, "No, Kiah, it's fine. It's fine."
Not going to delay everyone. We had signs in the back. I run a watch and I was like, "Oh, well, thanks everyone. Let's wrap it up." Everyone applauded. And then Alex is like, "Actually, we can just do his last slide, Kiah." And I was like,
"Well, I had more
Alex,
questions."
We can't. You know what?
I think everyone else did. All right. I will say the world depends on people like you, Kiah, being aggressive about timing. So, let's do our next one.
Okay. So final lightning round topic.
Okay.
It is apparently 1998 again because Citibank is out here in these streets potentially acquiring a bank. Now, yes, you heard me right. Citibank, that same Citibank that accidentally sent like $1 billion on accident instead of they paid off Revlon's loan instead of sending a payment on Revlon's loan.
Famous fat fingering.
Yes. Who among us, right? Like, may I never accidentally pay off a loan when I mean to send a payment for a loan.
Those bankers don't get promoted when that happens, right? It's not like in fintech when you crash a big VC-backed company and then VCs can't line up to give you more money.
When you lose $1 billion, sometimes you gain some clout. But when you accidentally just pay off a loan, and then you have to ask the lenders for the money back. And you said it's a fat finger. You're right. There was somehow Citibank's systems allowed them to accidentally make this. It wasn't I don't know, I tacked on a bunch of zeros or whatever. Anyway, So that same Citibank, actually, it was so bad that they got an enforcement action. And this comes at a time when Citibank is maybe not today, maybe not in 2026, but Citibank was famously dented after the financial crisis. It was so messed up that they had to form a bad bank and then try to sell off for 5-10 years the assets of that bad bank and get as much money as they could, a la fire sale, a la margin call, for the third time that movie has been brought up in this podcast.
Yeah.
So that Citibank is in preliminary discussions to try to acquire a U.S. regional lender to ramp up their deposits. And it's hard to know what has happened, who has been asked, has a regional bank in the United States been asked if they want to sell? But it sounds like the Citibank executives told their U.S. regulator this year, and that's a thing that we hear in the banking space is you never want to surprise your regulator with anything, certainly not an application for a deal.
Sure.
So this seems like they were kind of giving that heads up. And famously regulators aren't going to be go for it. But what they'll do is be and they'll kind of I don't know, use body language or facial expressions to indicate how receptive they would be to this. Or if they would be don't you think you need to tighten up your BSA, AML before, isn't that more important or than doing this, more urgent? And then that's your sign that you shouldn't do it or you should fix that thing first.
So it's I'm not saying I'm going to buy this, but if I was, that would be interesting, right? And you go, oh, well, yeah, but also what do you think about this? And between those two non-statements, they can come to an understanding about whether it's a good idea or bad. Okay.
I could never be a regulator for a lot of reasons, but definitely because I could not manage this kind of a conversation.
You would suck at that. Yeah, you're way too direct and argumentative, I think.
I'd be are you serious? Which is exactly what I'm doing right now. Okay, so it's apparently Bloomberg reported that authorities had openness to considering a concrete proposal. Now, Citi itself was the famous byproduct or pro forma institution after Citibank merged with Travelers in 1998, and this is the deal that we have to overturn Glass-Steagall.
Yeah.
And the bank, in addition to their kind of famous like issues post financial crisis, they just don't have a big lending or a deposit operation the way that, like, as we've talked about, JP Morgan loves branches because they bring in deposits.
Yep.
And so they're trying to figure out like what can they do to bring in deposits. And I guess the way that one of the top 4 banks in the country has to do this is by potentially spending billions of dollars to buy a bank that has about a 500 billion in assets. And so that group includes Truist, which is its own MOE product, BNC, which just did its own deal in Colorado. And so, I'm just literally being like, I just kind of didn't realize like the regulatory environment had changed so much that like this was like on the table. Like in like my wildest dreams, I don't ever banking dreams, whatever. I don't ever think Citi gets to buy a bank. Alex, what do you think?
To be clear, that's not like your wildest dream just across the board, but like within banking.
In my very specific banking dreams, where I'm like, what would be a crazy thing that happens?
Yeah, like you wake up, you'll never believe what I dreamed about. I mean, I think that everyone has JP Morgan Chase envy, would be how I would put it. So my sense of the market is that all the other big banks feel like Jamie Dimon and Chase are running away from them, and they have a limited window with which they could try to catch them. Or if they don't, that Chase will just end up so far out ahead, and they're not allowed to buy any banks apart from like troubled acquisitions, but they're like pouring money into branches. They want to have a branch within 10 minutes of everyone living in this country. Like they're rushing out ahead of the rest of the market. Same thing on the technology side, right? I think there's a perception that Chase is just dominating from a tech investment perspective among big banks. And so I think all the big banks are kind of looking around and going like, if we don't find ways to accelerate our just size and getting bigger faster, Chase will get too far out ahead and we'll never catch them. And so like PNC, Bill Demchak has talked pretty openly about like, we need to keep acquiring, we need to keep getting bigger. Banking is a scale game. Banking is a scale game. And Citi, when I sort of observe the Jane Fraser era, what I see is sort of like a badly executed version of the JP Morgan Chase playbook, all the way to like things like the Citi Strata card and stuff, which is like kind of a ripoff version of Chase Sapphire Preferred. And it's like not going as well. The execution hasn't been as good.
Yeah, the elite. There was like an elite issue.
And it's messy and it's not very good. And so I don't know. I get the sense that Citi under Jane Fraser is better at like cutting things down and just ruthlessly trimming parts of the operation away, which is what a lot of what her work has been over the last couple of years. I don't get the sense that Citi under her leadership has a real good idea of like how to build a bigger bank, which probably explains why they want to do this acquisition. But the question would then be, would that acquisition go well? Like, would it be a 1 + 1 = 3 situation? Like, I kind of tend to doubt it.
It's interesting because they have such a they closed a lot of their branches, and a lot of big banks did close their branches, but I think that kind of signaled to the market that this is just not a retail bank. This is a bank for multinational corporates, and I think in a lot of ways they decided that was kind of a sucker's game, and so the question is like, would they want to buy a regional that has a large retail presence, or do they want to kind of target that middle market bank? But if they're going for a deposit, and like the other thing too is like, I don't know how big the deposit hole is that they need to fill if they're targeting $500 billion in assets. But like, and and all of these things that the acquisition would take some time to pay off.
Yeah.
Did we ask ourselves about a brand strategy relative to that? Like, because they just don't have a great reputation as an operator.
No,
and,
I don't think they have the patience for it. Like, it just seems like they they want and again, this goes to the regulatory environment. Like, just because regulators singled they might be open to this does not mean this is a good idea for you at all, right? And
it's real Jurassic Park energy here.
Well, right, yeah. Like, just because we can do it doesn't mean we should do it. Like, I feel very strongly that they don't have any track record of being able to execute anything like this very well. And the other thing is, from a deposit perspective, the problem is the deposits are concentrated among all their other big peers. It's like even a really big super regional bank isn't going to get you that many more deposits. Like, it'll get you more, certainly, but it won't get you like that many more. And so I'm curious who they would target.
Do they want the geography? Like, they didn't want the geography. They closed all their branches. I do wonder now that I'm thinking about it, is there a succession play here too? But like Citi is just the complexity of Citi as a money center bank and with all of its trading, its international operations, like that's very different than Bill Demchak's job, right? Like
it really is. Well, and Citi's been trimming back on a lot of the international stuff too, right? Like they've been getting out of a lot of the things that they had expanded into. So I wonder, they haven't really talked explicitly about this, but I wonder if it's we want to be more of a retail oriented bank and less of a multinational corporates kind of bank. Like I being HSBC is not actually as much fun as you might think.
All right, that's all the time we have for that commentary. Now, I have not a rant, but we have a wild card topic.
We do.
We are not often in the news. We comment on the news, Alex.
Yes.
But our industry, which is actually not financial services, it is newsletter writing or
media content. Yeah.
Content creation, famously, has seen some announcements.
Yes.
So Plaid announced at the end of March that it was acquiring a newsletter called This Week in Fintech. And then at the beginning of April, OpenAI announced that it was acquiring TBPN, which is like a video, a streaming show.
Yeah.
And so I just wanted to kind of get some of your thoughts about this, fellow news writer, content creator to content creator.
Yeah, I mean, I would love to know your thoughts on it too. I think generally the reaction I've seen, which I agree with, is this is great for the people and companies who were acquired. Like everyone universally seems
congrats to them. Yeah.
Congrats to them. Happy for them. Jealous of them in some cases. So everyone on that side, it's like, oh, of course you had to do it. There's more skepticism on the acquirer side, both for OpenAI and for Plaid. And I think it's not so much a commentary on those companies as it is more of an observation that it's really hard to make the whole independent journalism, independent media, independent content creation thing work when you're owned by a company. And the thing I'm really curious about, Kiah, is how much of that is a reality thing and how much of that is a perception of reality thing, right? Because like credibility is a tough one. I think about this a lot in my job. Like, why am I credible? Partially, I think it's because the work is really good. Partially, I think it's because I try really hard to be honest and to just share my like genuine reaction to news without having too much of a filter or anything on top of it. But I also would be naive to think that part of it is that when people look at who I am and what I do, I don't have any obvious conflicts of interest. So part of it's a perception thing too. And there's not a real rich history of this idea, which other companies have tried in the past, like working. And so I'm curious why that is, and if there's anything structurally that OpenAI and Plaid can do differently that would actually make the outcome different, or if just inevitably the credibility of these organizations kind of starts to deflate as soon as that acquisition is made and that perception barrier is sort of breached. What do you think?
One, I had no idea that being a content creator was such a desirable position, so in demand.
Storytelling, man. It's like the thing.
Yeah. So I will say that you do not come from what I would call the traditional journalism background. but I do. I have a J school degree.
Yep.
And so I like really drank that Kool-Aid. Actually I still
Sure.
in this new role, really try to balance like what do I think is true about journalism and useful and provides like value to society, and what do I think like wasn't exactly serving the people who do journalism and the people who read and consume journalism. And that's like definitely like in our changing media environment. Now, media ownership is a really, really interesting topic. And we've seen, over time, like, didn't GE used to own NBC? And we've seen like issues with, the Jimmy Kimmel and Disney?
Yeah. And Jeff Bezos owns the Washington Post. Yeah.
Bezos owns the Post. Well, and I don't even remember if you know this, remember this, how Murdoch's ownership of the Wall Street Journal and Fox News have kind of created sometimes some uncomfortable conversations, or, for me, the thing about being a journalist is like sometimes people are not going to like what you say.
Right.
And journalists kind of like protect themselves with the defensibility of like accuracy, right?
Yeah.
But and like that should like that for me like starts and ends conversations. That is a legal defense. Like it works in a lot of places. Like it's a magic wand that works. It doesn't always hold sway with like maybe certain corporate owners, right? And the question is like, is anyone who wants to own like the content that another person creates, that they have paid that person to be the subject matter expert, are you going to like stand up for that person or disclaim like, hey, like if there's an error, please let us know and we will follow our accuracy protocols. But other than that, like we stand by our reporters. And we'll just kind of take the heat. And like maybe Plaid and OpenAI have like enough money that they can lose business over this, right? Or they can withstand pressure from like partners. The other thing too is I think I just want to acknowledge like in no way does business reporting come close to some of the other types of reporting as far as pissing people off.
That's right.
And so there might just be like, it might just be a little bit easier to like keep all readers happy when you write about business. But I do wonder, like, independence is important to me. It's important to you. I don't know how much independence was important to TBPN, a Bloomberg style talk show streaming.
It's like an ESPN show for text. For tech. Yeah. Well, and This Week in Fintech, like
we read it, and you know what I mean. Like it's pretty like it's a lot of information, but I wouldn't say a lot of what they present is like what I would say is controversial or anything.
No.
And so maybe these two media properties will just fully sidestep those issues. I also though would always be like, but why do you want to own it? Like,
well, that's the thing is, someone described it as like modern day patronage, and I think that's an interesting like frame to look at this at, right? Is it's like patronage was something equivalent to, you will work with me, I will get sort of a general brand halo for being the person who allowed Leonardo da Vinci to do what he does, and I'll be mentioned in the same sentence as you, but really, you're not taking any direction from me. I'm not directly benefiting from what you're doing. It's just like the brand association. Kind of reminds me of sponsoring a sports team, right? Where it's like half the value is I get to go shake hands with the players, and it's cool to sit courtside and like have my name on the stadium. So it's more like an ego thing, I think, in some ways. Yeah. And then the other half of it is this more of like, no, now you're our marketing team is the other way of looking at it, right? And I think TBPN is a good example where it's like OpenAI, like Sam Altman just can't help himself describing AI as like the worst thing ever all the time, right? He's like, I know AI models take a lot of resources to train, but like, have you ever looked at how expensive it is to train little humans and turn them into like productive members of our society? Like, do you have any idea what you're saying and the words you're saying out loud? Like, you are making people hate this technology. And maybe like the goal with TBPN is literally just, hey, come in and help us stop putting our foot in our mouths with like calm stuff. And so I'm curious to know like how much of it is we're just fans and we just want to patronize the work you do, arm's length. Maybe every once in a while our CEO will come on and chat or whatever, but like you do what you're doing versus this is a cheaper, better way to hire like a content marketing team than to just hire content marketers. And I guess every one of these deals is different, but I'll be curious to see how much what TBPN does is different post-acquisition. And with This Week in FinTech, like how their focus may shift or like what things they prioritize and how Plaid sort of is integrated. I'll just be very curious to watch.
It'll be really interesting to see if I worked at a media company that was acquired, and it was interesting to go through that acquisition and see like, and also the media side was not the money making side. It was the data. But they did invest in us. And then it took like a couple of years and they made some changes and there was a big exodus of people. And so, I don't want to say it's like all good or all bad. While I worked at that media company, I was sued and my employer paid for my legal defense. And that was really useful and important. And that was, I believe, a key risk of the acquirer buying the company that I had worked for was that you were buying a group of people who may piss off someone and may sue them. Now, obviously, like the company that acquired us was then subsequently sued by the U.S. government. So it's not like that they didn't have their own lawsuit risk. But there are these like things where it'll just be really interesting, number one. And then number two, I was like, okay, like props to everyone. Like, but like I write a little newsletter.
Yeah, sure.
So it was just kind of funny to like reflect on like, damn, people in my industry are getting bag over here.
No, it's true. I mean, I do think there is
You can get rich from writing a newsletter. Whoa, that is news to me.
Some people can, yeah. No, I think it's a good point, and I think it is reflective of one last thing, which is the value of storytelling. I think is really high and is becoming higher, particularly in a B2B context. And I think companies are starting to recognize that.
Say more about that. The 2 work week newsletter writers over here.
Yeah, well, like, I mean, I like to think what we do provides value. And so I do think these are interesting data points in that respect. And I also will say, and this is something I see all the time within tech specifically, there's a real frustration about people not writing about tech fairly. And, it's funny because from my vantage point...
too mean to the tech people.
Well, or, I think the flip side to the argument, which is also a fair one, is that people are too nice to the tech people, right? Like my main critique of TBPN is that it's far too just blindly pro-tech and never, ever critical of anything. And
no wonder the tech bros love it.
Well, right. And so I guess that's my kind of core point is there room in tech for not hostile to the industry, generally pro technology as a force for innovation and making our lives better, but also grounded in a deep skepticism of tech, especially when VCs and sort of financial interests get involved, right? And like, to me, I think it is possible to occupy that middle space, but I also think that would not make folks who do that type of work, and I like to think you and I do that type of work, we're probably not great acquisition targets because we're maybe a little more like studiously neutral on tech as opposed to pro or con. It feels
agnostic,
it feels like a lot of times the current environment is trying to pull you either pro or negative, and I actually find it really hard on a week-to-week basis to just be rigorously agnostic and neutral about it.
Yeah. All right. Well, Alex, it was so good to catch up with you.
Likewise.
See you in New York, and I'll talk to you next month.
All right. Thank you.
Thank you for listening to this episode of Bank Nerd Corner. Stay up to date with news and trends in the bank space by subscribing wherever you get your podcasts. Also, if you love FinTech Takes Banking, please tell a friend. Talk to you next time.